Hello everybody and welcome back. In today's video, we discuss everything to do with the stock, crypto and commodities markets right now, including the key levels that you need to be watching over the next 24 hours into the next few weeks. We've seen a rally that almost is like no other. Large companies across the world, the biggest ones, have been going up now for 11 days straight. I can tell you that's statistically unlikely. Does this mean that we're going to have a sell into the end of March though, or even into the start of April? Well, we'll be taking a look at that today and breaking down the key things that we need to be watching in these markets. Stay tuned. We'll see you soon. Well, welcome back to our daily show here, everybody, and this is for the markets close the 29th of March 2022. So we've been talking about risk on being the big thing of the last couple of weeks. It continued through this session, almost to a little bit of our surprise, and we'll talk about that soon. But really, it was the story of hyper stocks that were the best. And if you like anything to do with stocks, cryptos, or commodities, make sure you subscribe and of course smash that like button if you find value in today's video. Let's talk about what happened during the session. The retail hour of power. All markets jumped out of the gates very strong. They actually worked a little bit above resistance, and that resistance therefore became support early in the session, which we had theorized could potentially happen. After that point, we ended up closing very, very bullish, especially for IWM. That is the smaller cap hyper stocks. That's what really did so well. When we take a look at the sectors for the day, it was really things like clean energy, biotech, software, technology in general, and hyper stocks that had the best returns on them. And it was things that have been doing well for 2022 so far that didn't do well. Metals and mining, agriculture, energy, they were the worst. So it was a risk on day for the markets. That much is clear. Now, why are some of these things occurring? A lot of people are talking about rebalancing of the books for Q1. So rebalancing is certainly a thing that occurs in all markets, especially the US market, and we must understand that. If you actually look at the last days of March, they tend to actually be quite weak in the major indices, but not necessarily in IWM. Did you know that the Russell 2000 is up 24 of the last 32 March 31st? And it's actually down on the Dow the last 20 of the last 32. So that's a bit of a flip-flop in terms of what's doing well and what's doing poorly. Another thing that occurs is we tend to see a real rebalancing into a stellar April. A lot of people don't realize that April is one of the best months in the year for being in the US stock market. And that's part of the reason why I think we're seeing risk on now. There are so many reasons to potentially be bearish on the markets, but of course, the markets can stay irrational longer than you can sometimes remain solvent when it comes to being a bear. It's not easy being a bear in the markets. Remember that. Much easier being a bull. So from April, we usually have 15 of the last 16 years being bullish. In fact, they've been historically incredibly bullish. Even on the worst one, it wasn't even that bearish. So this is a stat that you look at and you think, wow, can I really fight the system here? And I think the answer is, in general, you probably can't. Why? Because even if you think the market's going to go down, you need key lead indicators to be telling you that that's going to occur. If you look here, though, there are sometimes some respites. So the back end of March, historically, a little weak. We'll show you a chart on that soon. The start of April, a little bit kind of all over the place, usually followed by a nice rally and then some weakness in the end of the trading days. A lot of this has got to do with earnings. What happens in the US stock market ahead of earnings? They get optimistic. Everyone's happy. Will this earnings be good though? Remember, sell in May and go away is a saying that people have. It hasn't worked for a very long time because it's not that statistically likely. But when it happens very, very fast and hard. And this is theoretically one of the years that it certainly could occur. We'll show you that later on today's video. Another thing that's happening right now is, of course, 10-year and 2-year spreads on Treasury yields are inverting. We're so close to a US inversion, which is not good for the long term here in the markets. It's not going to crash the markets in one day, but what it does do is it tends to be a bit of a precursor to markets failing in the future. Whether it's 12 months, whether it's 18 months, yes, it can be quite far away, but it's not a good sign on how the market is viewing long-term growth in the stocks. We've talked about midterm election years. I bring this chart up. Long-term viewers are probably sick of me bringing this chart up, but I can't stress how important it is. You'll notice that often that end of March tends to have this little bit of weakness here, and then you tend to see rallies into the end of April. And these midterm years, especially Dem midterm years, tend to really show weakness at the end of April into May, and that sell-off kind of occurs again. This is just statistical likelihoods. Does it look like the current market right now? Well, in some ways you would argue, yes, it does. Let's get into the technicals though. We'll start here by talking about some bigger, longer term stuff. Then we'll go into some individual commodities. And then of course, we'll go through our indices and cryptos. But let's just quickly talk here about the US 2-year versus 10-year. This thing is about to invert 0.987. It's coming faster than even I had thought it would occur. This is not good for the US economy. It is not good for the world economy. It's bad. It shows sickness. The longer it hovers above these types of periods of inversion and the longer the market ends up going up, the more sure you can become that there is a recession on the way. Unfortunately, this is one of the leads into recession, along with things like high oil price, which obviously we are seeing at this stage. Let's talk about the VIX. The VIX has come down a lot. Our opinion means very little, remember, because we're trading the here and now. Investments, you have to think a little bit longer, but trading, you're looking at the day-to-day, the week-to-week, the month-to-month. So the VIX is coming down. This means that volatility is currently coming out of the market. The fear that was once there, it's all subsiding into the month of April, one of the best months of the year historically. The bond market has stabilized as well. You might say, Tom, it looks down. If you know how to read bonds, I'm telling you right now, the bond market, from the perspective of how it looks to the market, is actually being bullish. But I just want to show you here, corporate bonds have stabilized, at least on this chart. And that's a very important thing when you think about it versus yields. Let's move over to gold. Now, gold is suffering. It's not doing so well here. You would think, oh, maybe gold should be doing well. Well, I'm here to tell you one thing. Gold is not really an inflation hedge, though it does do well in stagflation. If you don't believe me, you can look up some charts. In fact, these are the types of things that you really should be well aware of. And we'll do a gold, we'll do a commodities thing during stagflation, because I think it's important we do a video on really how stagflation affects markets, and if we're in it right now, what could be the best investments of the next couple of years, or best trades of the next couple of years. Gold for now did do a nice bounce. Look at the technicals here. Off that, of course, big zone of buying pressure, and we've seen nice bullish hammer appear. Now, if you're trading these bullish hammers, the way you need to look at it is you want it to follow through. That is, momentum continues on with your order. Basically, you see buyers come back in, the momentum comes through, and they break to a new high. It doesn't mean they have to close to a new high, but they break to a new high. If you just buy after you see candles like this, you tend to get stuffed up. If you have had that happen to you, put your comments in the comments down below, because it's happened to me. I'll put my first hand up. I learned from a while ago, a very long time ago, that when you're talking about trading bullish hammers or pin bars or any of these types, you need the momentum to follow through. If it doesn't, all of a sudden it can go through backwards against you and you're in pain. What you want to be doing here is looking at a breakthrough of this, and then obviously hopefully a return back to that 1960 zone. If it doesn't, well, it's not giving you a strong enough signal. Let's look at oil, a fairly similar kind of chart here. A big sell-off followed by a decent rebound. We warned into the 50 to the 78.6 fib that we expected weakness here. We got to the middle, which is the 61.8, the golden fib ratio of that massive dump into the rally. That's a good area for you to start to remove positions, because what this dump was telling us is there's weakness in this market. After a parabolic run, we had a weakness show up. Now, I'm not saying oil is over, but I do think oil won't be the phenomenal investment it's been recently. I think a lot of that's come out of it. And if you're looking here, this is not the chart that I'm very interested in at this stage. The facts are that it's more of a day trade, scalp, that type of thing. The longer term investment might be out the door until we see some more clarity at this stage. Let's move over to the broader market, Tesla. So first off, 1100 here on Tesla. It hit the resistance that we had hoped it was going to hit. Now, you might say, well, why is 1110 your resistance line? Well, purely based on these previous resistance areas. This is the stock that actually showed some weakness for the day. It actually gapped open, but ended up doing a pretty decent little bit of a sell-off through the session. So that was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days in a row before a red candle. historically incredibly unusual for this to occur. Now, most Tesla traders would be aware by now there's a gamma squeeze, or at least a squeeze going on in this market. The stock splits certainly help to really exacerbate that and force it up. But I think whatever you're doing in this market, if selling does occur, alerts may need to be set for next levels of structure. Now, I'm not sure it's going to go down to the 950 area, but that certainly was a previous huge resistance that could be acting as support. And remember, if this does occur, and we'll be watching it if it does occur, you've got a 20 and a 50 moving average there. A lot of people say, oh, I'll be buying that so hard if it comes down, or whatever you might be looking at. But remember, this is the type of thing where when it happens, are you ready for it? That's the big one. For Tesla traders to the bull side, you're looking for it to break through the 1,110. And upon that breakthrough, many traders will be looking to take it to 1,200. Why? Because there's really very little restrictive kind of structure in between these areas. So bullish people on the day trade will be looking for a follow through in the next session. And if they get it, they might be trying to take it to the 1,200. It's the most logical conclusion for Tesla to the bull side. Remember, there's always a bull case and a bear case. You've got to be open to both. If you scroll down to something like a 15-minute chart and you start looking at it, of course, it really subsided in the end of the day in terms of trade. You've clearly got some support here. I think bears will be looking to fill gaps such as this one here over any type of short underneath that. Something to watch in the next types of sessions. So certainly one to keep an eye on. Now, we mentioned before that there is a stock in the world, the biggest stock actually, that's insane right now. And when I say insane, it's not that it isn't possible and I think that it's ridiculous. I just think that it's statistically unlikely to occur. So you've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Wow. Just wow. 11 up days, not one red. Now that is unusual. It's unusual, yeah? And we had a statistical resistance here. We had a technical resistance that we thought, okay, well, maybe Apple tries to stop there. Hey, we got no signal to short. And that's the key. It's not so much your opinion. Your opinion doesn't mean that much. It's if you find a key level of resistance or support and you see the market show you the signs of turnaround, e.g. a miniature lightning bolt to the downside, a little double top, some rejection wicks, a long leg doji that then breaks to the downside. If those things occur around this zone, you can say, see, I knew that was a good area. Then you're getting confirmation from the market. But just shorting random areas is not the best thing to do, or even shorting high quality areas. So Apple has moved up again. Is it going to go to the 182? Wow, that would be pretty cool if it gets up there, because that would put you on maybe 12 or even 13 days straight of green. And the longer it goes, the more I become looking towards the short, more if the reaction ends up happening. And the reason, because it's statistically unlikely that it should have rallies that are so green like this. It's something that, in my trading career, which has been 14 years, I haven't seen that often, that many days green. So I'm going to pay attention and obviously look for the signs both ways. Does it mean that you start selling everything in the market? No. I mean, you've clearly got risk on here in the market from the price action. However, you would be looking for opportunities should you see them arise. Now, we talked about hyperstocks being the best market of the previous session. You can tell by ARK that was certainly true. All of the hyperstocks that ARK has all of a sudden came back to life and they were moving heavily. Now, one of the ones that we bought up in our private community pre-market open was Twilio. And the reason we bought Twilio up, well, firstly, just quickly, ARK 76 is kind of that next resistance after this point. Just closed right on here. So if it gets through, 76 could be that level, 76, 78. But let's have a look at Twilio. Let's bring that one up. Now, most of you would recognize this as a bit of a flag. And it was coming off a downtrend. And you've got to remember they had the earnings. This is just an earnings gap up and an instant sell off. So you can neutralize these candles. If you're not aware why, you probably need to start looking into that. But certainly a neutralized candle. And it had a little flag here coming into the session open. Big day for it, 8.5%. Hyperstocks in general just have some really nice bases. Whether it was PLTR, which was something we were looking at on the Monday stream, a very nice base, obviously some big volume through this day, now at resistance, or whether it was a square which was showing a Wyckoff accumulation, another very strong consolidation above the moving averages. These are the types of things you look for in recovery. So I think that was probably the best area to be in the market in the last 24 to 48 hours. These have all been coming down to really key zones, and I think that's why they've provided such good entries. They've just had great technicals on them, and I'm sure a lot of you, some of you might kick yourself right now and say, oh, I missed the opportunity or whatever. Don't worry, there's always another one in the future. You've got to always remember, it's not scarcity of opportunity, it's just being able to find the ones that are statistically probable to have success. So we've talked about risk on. How do we recognize risk on? One of the reasons, or one of the ways, is XLY. That is consumer discretionary. You'll notice here we had that triple bottoming effect. We broke through. We've talked a lot about the 16th and 17th of March just being risk on for the markets, and everybody suddenly was piling in. Now, this has been an incredibly aggressive market. Again, very aggressive. Sometimes it happens. Some people will argue low volume, this, that, whatever. It doesn't matter. The point is the trend is still up. Now, is it starting to get a little carried away? Well, you can see it's hit kind of a level where you've got previous supports potentially becoming resistance around this level. You are cautiously looking for signs of pullbacks, because if pullbacks occur, firstly, that's healthy. That's actually a good thing for what we expect to be a potentially good April here. You need pullbacks so that you can get nice returns. If you just have a vertical ship to the moon, that's unhealthy. And then what ends up happening is you get monster crashes. And I don't know if you want a monster crash, but I don't really want like a crash that is one of those parabolic into 20% off in a day or something. That would be less than ideal. So at this point, you're looking for the signs. If you're long, there's no reason to say that the market is going short yet, other than it's hitting these key levels. That doesn't mean it's going short, but you want to see the signs. Now, how do we see the signs? Well, one of the things we were talking about is the DAX. Now, the DAX certainly didn't hold itself on the resistance yesterday. It actually broke straight out. But take a look at where the DAX is now. Let's just bring this up here into the end of March. The DAX is back on a level that caused all of this massive shorting. It's back on 14,921. And actually, ironically, if you bought the DAX at the bottom, would you have done better than the US market? The answer is yes. You would have been 19.59% up in the recovery here. But do we remember what the DAX was? It was a giant Wyckoff. Here are the false max pain breakouts. Here's the massive support, and we're back at that resistance. Is this a point that we should be paying attention to from the DAX showing us that maybe we're at that resistance here where we should be starting to say, well, you know what? Maybe 11 days in a row is too much. Are we at a resistance? I think you're starting to point towards it. And if you see the right signs, you could suddenly say, okay, well, maybe it's time to short. Hyperstocks are a little bit different. Hyperstocks seem to be breaking out here. At the same time, IWM has broken through our 209 and it looks to be going strong. And that's coming off the back of some decent little rejection wicks as well. So any pullback you would think would be met by buyer demand here in something like IWM, the Russell 2000. Let's take a look now at the Nasdaq. So the Nasdaq's on the 61.8 fib. That's the golden fib ratio. It's pretty much closed, I would say, right around these previous absolute peak highs. It got through the daily 200 moving average and it came out of the gates incredibly strong. Let's actually look at the chart here. We'll use the futures just to get a bit better of an example, and we'll go into the 15-minute chart. So what actually happened on the session was we came out incredibly strong. We sit at a 15,221. We instantly short off, okay? Pretty quick to short off. And we start shorting, and it wasn't a bad short if you were in there for the day trade, and we come straight back down to the previous day support, or the resistance here that becomes support. That's where we rallied. When you're looking for weakness, the problem is you need it to continue to go back through even lower. When it gaps open so much, really what it's doing is it's filling that gap, and then it goes on to the next rally. At this point, we're sitting at around 15,228. So if we see it kind of hovering around here, and then we start to see it fall off, what you're looking for is you're looking for some kind of lightning bolt. Now in the Nasdaq, if it had done this, bang, bang, new low, 15,040 new low, would that have been a signal put towards the short? You would have to think, yes, it would. Why? It's a change of trend. on a significant time frame with the right type of sequences at the right area. So you've got to be very careful. Remember, being short is hard. Being long is relatively easy. You're going with the companies. You're going with companies that literally employ people to make money for them. It's hard to be short. You've got to be very, very careful, especially during a rally like this. Here we have the S&P 500 sitting at 46.31. Here's the problem. It opened above 45.88. It actually opened above the resistances. You can see it here. Then it came back down, touched those levels. They became support for the day trade. We didn't know it was going to happen, but it did. And then when it came back down, buyers instantly bought that. I don't blame them for buying that. It's a massive rally at this stage. So this market has now gotten through all of the key kind of fibs. If you bring up the fib retracements, you think about what's going on there, you would instantly say, okay, well, it's gone through the 61.8, it's gone through that resistance, and we're in kind of a point of it's very hard to call. Absolutely. You would think it may even go even a little bit longer here based on what's occurring. But I think you've got to be cautious. And that means that you're looking for the turnaround should it occur on a significant time frame, because it makes sense due to the fact that Apple is up 11 days in a row and these types of things are occurring. Something like 45.90, you can see it's bounced off that, back up. Does this become a key level of support for intraday traders? I would certainly think so. If it breaks underneath those levels, does that become significant? It tends to become significant. Those types of things occur. So certainly worthwhile watching here throughout as the week ends up starting to happen and continue. Let's have a look at Bitcoin. So Bitcoin's another series of risk on. At the moment, some people are saying Bitcoin actually predates or moves ahead of the market itself. Well, here we have 48,000 that's been reached. And if you take a look at the 48,000, it's got two rejections on it. If you follow through that rejection, does that mean Bitcoin comes back down? It seems likely. It's basically kind of like a tweezer top here. And if you get the follow through momentum, that won't be good. Now, where do we expect Bitcoin to find buying pressure? Well, you would have to think somewhere around that 44, 45 previous resistance, you would find buyers. And that would be where the 20 moving average is at the same time. Just something to keep in mind here. Now, if Bitcoin cracks this 200 daily closed above, is it on fire? You would have to think so. 52K would become your next resistance. Remember, a trader doesn't have a bias in the direction really, other than the trend. You're just looking for the key level breaks, and when that occurs, does it become statistically likely that it moves to the next area or zone? Something we teach in our courses, and I certainly really bring it into people's minds during our mentoring. Let's talk about Bitcoin shorts. Bitcoin shorts still very low. That's a good sign overall for the Bitcoin market. And I want to talk about Ethereum, because Ethereum has been a very interesting one. Obviously, Ethereum has been our pick here for the last couple of days. It's been running in lockstep with Bitcoin. And if we actually load up FBTC ratio, what you'll notice is that it's coming under pressure. So that 0.72 area, we're looking for a closure above that to show us that Ethereum is ready to decouple from Bitcoin and outperform it. At this point, they're pretty even. They're almost together. You can see it here on the charts. They've been sitting there together for a little while. So Ethereum may be the better one to be in, just because really what that's showing us is that they're moving the same way. But as we've detailed many times, Ethereum is actually underpriced to Bitcoin right now as a ratio. So it should be a little bit higher. And that's just as the risk on comes into the market, usually Ethereum starts to come up to more fair ratios to Bitcoin. So there could be some little problems here in the crypto market over the next 24 hours. We follow that resistance potentially down. And at the same time, if that's occurring, could the US stock markets also fail? Well, they may fall through. Remember, there is a lot of buy demand here. April strong. So if it rips down and it starts to short, do we think buyers may come back in? I think the answer is probably yes. We've also got one of our lead indicators at the moment. Come and follow us at FX Evolution. Obviously, Kramer going all in about 24 hours ago, saying it's all time to buy. And you know what happens after Kramer says stuff like that. In terms of big news, we have here a few things. We've got the Wednesday ADP non-farm employment change. We've also got the Thursday core PCE price index. And then we have the big one, non-farm employments and ISM manufacturing PMI on Friday. This news will move markets, however, or always does with non-farms. However, non-farms is incredibly hard to interpret. So remember, whatever the news is, it often goes in one direction and then suddenly reverses into the other, leaving you thinking, what is going on? You need to be reactionary in this market and not so much too predictive. Thanks for watching. If you enjoyed today's video, subscribe, smash that like button. We'll see you in the next one. Bye for now.